All right, today we're going to crack open a trading secret that's been hiding in plain sight for decades. It's called the 4-week rule, and it's designed to answer one of the toughest, most gut-wrenching questions in all of trading. And that question is, when do you really know it's time to sell? I mean, you know the feeling, right? You're riding a winning trade, everything's green, and then that little voice in your head starts whispering, is this it? Should I cash out now? Sell too soon and you might miss a huge run-up, but wait too long and poof, those gains can just vanish. It's a constant tug of war. And that right there, that's the heart of the trader's dilemma. It's this massive, head-on collision between cold hard logic and that absolute roller coaster of human emotion. You know, fear, greed, FOMO, these aren't just feelings, they're actively trying to sabotage your trading plan. So what you really need is an escape from all that noise. You need a system that's purely objective, something that acts like a GPS for the market, guiding you through the twists and turns without any of that emotional baggage.
So let's pull back the curtain on this solution. This is a system that was literally forged by a trading legend, and it's designed to do one thing really, really well: cut right through all that emotional fog and give you pure mechanical clarity.
It's called the 4-week rule, or 4WR for short. And it was the brainchild of a guy named Richard Donchian, a figure so influential, people literally call him the father of modern commodities trading. Now get this, he came up with this trend-following system way back in the 1950s, and its genius is just how simple and totally objective it is.
And here's how beautifully simple it is. You ready? Rule number 1, if the price breaks above the highest it's been in the last 4 weeks, you buy. Rule number 2, if the price drops below the lowest it's been in the last 4 weeks, you sell. That's it. Seriously. No crystal balls, no listening to your gut, it's just letting the charts do the talking.
Okay, so that's the theory. Sounds easy enough. But the big question is, does the system from the 1950s actually hold up in the crazy chaotic markets we have today? Well, let's put it to the test.
So the big promise of the 4-week rule is huge. It basically ensures that you are on board for every single major trend. But as you know, in trading, there's no such thing as a free lunch. Every powerful strategy has a trade-off. So what's the catch with this one?
We'll take a look at these real-world examples. A long trade on Google? The system snagged an 18% gain. What about a short trade on Goldman Sachs when the market took a nosedive? Bam, another 18% profit. It's pretty clear, when there's a strong trend, this rule absolutely delivers. But, and this is a big but, this is where you see the rule's Achilles heel. Look at that Google trade. At its absolute peak, that trade was up over 30%. But because the system is 100% mechanical, it had to wait for the price to drop to a new 4-week low before it signaled an exit. And in the process, it gave back almost half of the potential profit. Ouch.
So let's break it down, the good and the bad. The 4-week rule is an absolute machine at catching big trends. That's the pro. The con? Well, markets only trend about a third of the time, which means your win rate is often going to be below 40%. And in those choppy sideways markets, you can get nicked by a bunch of small losses. And yeah, like we just saw, it's literally designed to give back some of your profits before it confirms the trend is over.
Okay, so that might sound a little discouraging. But what if you could take all the power of this rule, but get rid of some of its biggest flaws? I mean, the original 1950s design is a fantastic starting point, but the real magic happens when you start to refine it. I like to think of the basic rule like a classic muscle car engine. It's got a ton of raw power, for sure, but what happens when you bolt on a modern turbocharger? Or upgrade the brakes? You start customizing it to fit your own personal style.
So here are 3 powerful upgrades you can actually use. First up, you can totally change your exit rule. Instead of waiting for that 4-week low, why don't try something like a 10-day moving average to get out sooner and lock in more profit? Second, you can use it as a trend filter. This is cool. You only take buy signals on your favorite stocks if the overall market, like the S&P 500, is also in a 4-week rule uptrend. And third, you can apply its principles to something like Dow theory to get really objective signals about major market shifts.
Let's go back to that Google trade for a second. Remember how it gave back a ton of profit? Well, check this out. Just by switching the exit to a 10-day moving average, a trader could have boosted their profits by about 25%. Think about that. That is a massive difference from one single simple tweak. Okay, so as we start to wrap this up, it's becoming pretty clear that the 4-week rule isn't some rigid one-size-fits-all system.
It's much more of a foundational idea, a really versatile tool that you can and should sharpen and adapt to fit right into your own trading toolbox.
This whole time we've been circling back to one specific number, 4. 4 weeks, 20 trading days. It sounds so precise, doesn't it? So deliberate.
And that brings us to the big final question. Is there anything actually magical about the number 4? And the answer, which might surprise you, is not really.
See, the real power here isn't locked into the number 4. It's in the concept behind it, using a new high to signal go and a new low to signal stop. There's nothing stopping you from experimenting with a 2-week rule for faster trades, or maybe a 10-week rule if you want to catch those huge long-term trends. The whole goal is to take this core idea and adapt it to fit whatever market you're trading, and more importantly, to fit your style.
And that really brings us to our final, most important thought. The 4-week rule isn't meant to be the final answer. It's actually the beginning of a question. It's a simple, objective framework that you can take, build on, test, and innovate with. Its true potential is only limited by your imagination as a trader.